Yep. Mm-hmm. Freeport. All right, it's 5 o'clock.
Okay, since it's 5 o'clock, we'll call this meeting to order. Madam Clerk, could you please take the roll?
Mayor Miller,
Here.
Alderpersons Borneman, McClanathan,
Here.
Ross is absent, Parker is absent, Busker,
Here.
Brashaw,
Here.
Mysick,
Here.
Berberay is absent, Art Ross is present.
Okay, if you could all please stand for the Pledge of Allegiance led by Alderman McClanathan.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay, first on the list is the approval of the agenda. Is there such a motion?
So moved.
Second.
We have a motion made by Alderman Brashaw, seconded by Alderman Mysick. All those in favor signify by saying aye.
Aye.
Opposed? That motion passes. Public comments, there's probably none on this.
Madam Mayor, we don't have any public comments signed in. Let me
Good.
I'll go through the rest of the agenda then on that finance COW.
I'm sorry.
It's all right.
You are correct.
You're doing a wonderful job.
I was just ready to get going.
You're doing a wonderful job. But
My apologies, Alderman McClanathan.
no, that's all right. Public comments had nobody signed in regards to that. The next item on the agenda is the presentation and discussion of the pension bonds. Stephen Roberts, please. Thank you.
Well, it's a pleasure being back here. As you can see in the book I handed out, it's very similar to what I presented last time with a slight alteration. So I don't know how you'd like to go about this, but would you like me just to go through that or that slide? Or?
I think so. Let's start with the differences between, or the additional proposal and how it changes. And as you said, a lot of the rest of it was what you had spent a significant amount of time presenting last time too. But anything else you want to touch, feel free to.
Perfect. Maybe what I do is juxtaposition various options. What we did in this book is we eliminated the first option that we showed you, the one that I identified as less attractive because it didn't fix the problem of the city. You saw, what's the problem? Is you see your payments going up to support the pensions. And if we did what's called a level savings, you wouldn't fix the problem because savings would track and you would see that upward slope. So what we did, you can see that upward slope right there, is that was the level savings. And the city came back to us and said, what if we were to do another a scenario 3 where we had a bit more savings in those first few years? You wouldn't see a huge ramp up in your debt service versus what you're paying now to support your current unfunded liability. And basically, it would look like that. You can see that aqua color would be the savings, and then it would level out in year 2029 to have a consistent payment. So if you want to look at page 13 of the book I handed you, that basically shows how it would look. So as we discussed last time, you can see the annual payment to amortize the unfunded. That's 3.2, excuse me, out to 5.9 million in 2039. Then there would be a taxable bond issue done, principal of $49,170. Interest, you can see that interest at $370. Net debt service, and in that gray box is how the savings would look. It's basically $300,000 in savings, ramps up 400 and then to 800, and then you can see all the way up to 2.2 million in 2039. Why is that? What do you see here is basically the total debt service. We're pretty close to the current levy of 2.895, and how we structured this, we basically increased it 100,000 per year out to 2039, where we level off. So that is how it looks today. I should mention, you guys have probably been following the markets. Stock market's been up and down. When you see huge dives, like last week, where you lose huge parts, what they're calling a market correction. You look at the opposite side is the tax-exempt bond market, where you're seeing rates come significantly down. We just priced a deal, and we're sub-1 out 10 years. So you're starting to see historic lows on the tax-exempt. What's causing that is a lot of investors, you read about the coronavirus, you read about economic uncertainty, they are fleeing to tax-exempt safe products, gold and treasuries and year bonds. So that's why you're seeing interest rates come down. So I'm free, the rest of the pages are pretty similar that I went through last time. I'm here to answer any questions. We have Kevin McCanna here too.
I'd open up the floor to questions. Alderperson Brashaw.
Thank you. We do see a lot of savings with going with this, but what are the risks that we need to be concerned about?
That's a great question. And I will, let me just, on the page through my book, because we do disclose those risks in here. And the chief risk is, this is arbitrage. So the whole point of this is you're borrowing at low interest rates in the taxable market, and then you are investing those. So if you look at page 15, you'll see that there's 2 pages of risk. And the first one is the economics of this deal will not be determined until you make your final payment on the bonds. So we are assuming for these savings is that you earn basically the 6 3/4 that or the 6.75% that you're assuming. If you earn more than that, you generate more savings than are in this book. If you earn lower than that, but above what you pay on the bonds, you're going to save, but not as much as in here. And if you don't earn what you're paying on the debt, which is 3.7%, you're going to lose. And you shouldn't have done the transaction. So this really, as I said last time, is for you to determine what is a reasonable expectation for future earnings. What have you seen in the past can be a gauge. I mean, that's no guarantee of the future, but it's an important question, what you can earn on the proceeds from the bond issue. I go through some other risks that are in there. You're investing a large dollar amount. We talked last time, mitigation you can basically invest the funds, you can borrow less, but one risk is that you're going to borrow that, put it into an up market, top of the market, and who knows what could happen to those proceeds. But I tend to say it's hard to time the market. Page 16 is the next. All of the POB proceeds have to be deposited into the system. It's very hard. If you were to keep them out of the system and say we're a little more confident with our own investment manager, the problem is you wouldn't extinguish the unfunded. It would be still a liability. You would have an offsetting asset, but a lot of communities, the whole point of this is to eliminate that unfunded. So it would have to go into the systems. POBs are hard liabilities. If you issue debt, you have to pay debt service. Sometimes in the past, communities would say, let's take a pension holiday. But I would argue you have a hard liability right now in that unfunded liability because you have to be 90% funded by 2040. But the point is you're going to have, if you do bonds, you're going to have to pay principal and interest on those bonds, which is called a hard liability. Additional unfundeds can open and probably will in the future. That's not changing your risk profile. That can happen right now, as you guys know better than anyone. But this is not a magic bullet that will fix it forever. And you will be responsible for normal costs in the future, which is, again, you're right now responsible for that unfunded portion and the normal cost. This is only proposing to fix that unfunded that you're accruing an interest rate of 6.75%. This will not touch your normal cost, which is a good thing because rating agencies tend not to like that. They'll see it as trying to help your budget, prop it up. So those are the chief risks.
Follow-up? Or additional questions?
Yes, thank you, Chair. I guess one of my follow-up questions would be directed to Manager Crow and asking how many other communities, what percentage of other communities are looking at this, the POB bond analysis as a type of helping hand to their community?
So, Stefan's been doing more and more of these briefs. Is it Winnebago County just did it?
Yes, we did Winnebago County in December of 2018.
So that's one.
There's other, Kevin, I know you have done.
Yeah, there's at least a couple others, such as Round Lake, the village of Round Lake Park did theirs. They actually went to referendum and let the people vote on it because they're non-home rule and they couldn't do it without going to referendum. I think there's certainly others looking at it. There's probably, in Illinois, I think there's probably like 4 or 5 who've actually done it so far. But it's a very current topic, and certainly nationally, it's becoming pretty common. The trade newspaper keeps talking about there's more and more taxable bonds coming out, and it's really because of this. Usually you see, especially states are doing a lot of them.
I know Dixon's also looking at it. They've gotten a brief. Our representative for Blottenbacher name is our actuary.
The actuary for each fund. Also, Berwyn has done it. Rantoul has done it. So those just a few others that we've worked with that have done it. Berwyn's is a little bit different versus a one-time payment. They've actually structured it over 4 different payments. They'll do pretty much 25% of their obligation and not try to put all their eggs in one basket. They structured it out that way. So again, as Stefan said, you can't time the market. So they didn't want to do it all at once and rush into it. They've done it over a series of payments.
And sir, just for the Madam Clerk, can we make sure you teach your spelling of your name for the record?
Certainly. Last name is spelled R-I-E-T-Z.
Thank you.
Alderperson Brescia.
Thank you. Has the council discussed this in the past about breaking this into separate payments rather than putting all the eggs in one basket, as this gentleman just said that the other community did?
I'm not aware that we've talked about what happened on the, and I don't know that we've, on the floor, significantly talked about that. Do you want to expound a little bit in regards to what that model was, or what that looked like?
Reitz?
Yes, certainly, and partially not. It was they have very large payments. They issued I think somewhere over $100 million of total was their overall obligation. So that was a very large amount to do at one point in time. So they did want to structure that out more. Your fund's about half that, around $50 million. So again, it's that was just the decision that their board had made and discussed and how to structure that. And they were comfortable. They were, in the similar funded percentage you guys are at today when they started this, and they're just seeing it ramp in over time versus, again, having it all go into one time and then having an adverse market hit at that one time, and it would put you, in a similar situation fairly quickly if you didn't have the ability to contribute or get out of it.
I appreciate that input, and also it is something for us to consider when we're talking about all these dollars.
Sure. And I think one of the things that we discussed in the past when we're looking at this was some of, I would say, kind of the failure stories, like even looking at the state of Illinois where they only did a little bit, and that, a little bit didn't make any impact on the whole. Other states that did a percentage, and then they're still dealing with a significant unfunded liability. So I think that's why you guys have brought, when it's actually come to the floor here, and we've had presentations, it's been in the context of, all right, what does it look like to take care of it as a whole? Because then you're starting off with at least at that point in time, the elimination of the unfunded liability at that point, and then just the debt service on it, as opposed to, again, most of the horror stories that I've come across, and you guys are the professionals, you may have seen it differently, but most of the horror stories I've seen is when municipalities attempt to do just a small portion that doesn't really address the underlying long-term problem. But am I wrong in that?
Well, I mean, it's just a different financial outlook that you have. you know, it is a long-term obligation. There's nothing in the statutes that say you have to be 100% funded tomorrow. So some take a different view of what is the appropriate point in time to be 100% funded. And it's not issuing bonds every single year. Berwyn doesn't do it every year. They'll do it for 1 year, take a couple years off. If they're getting market indications that this isn't a good year to do it, they may wait. You know, but they have committed to do the whole thing, and again, to still stay in line to be funded by the 2040 targets, and, you know, making sure they're making progress. They also alternate the amounts they do. 1 year they'll do police, the next year they may do fire, so they've structured it many different ways of how they wanted to take care of it.
Additional comments on that?
Yeah, and I will just say again is, you can also, there's two sides to this story, is rates are at the absolute low where you can come into this. But where you see some of the, what we'll call horror stories is what we see our job with Kevin is to protect your bond rating. And where you see a lot of the horror stories is the state of Illinois borrowed for normal cost. Right there goes up a red flag, and we're not proposing that here, is you'll see it automatic. We saw one community have a 3-notch downgrade, which would be terrible for the city. But we are talking only about the unfunded. So we can, it's where people see it as budgetary relief is where you see the horror stories. And again, I'll say this proposal is not that.
If I'm reading your presentation correctly, then in regards to that, if the assumptions stay static, and all of the assumptions are met kind of across the board, which you've given the applicable caveats in regards to that, but assuming the assumptions stay on board, our current $48 million unfunded liability, or actuarial unfunded liability, under the, what I call just stay the course, would lead to about, and if we were to put it out over that, I forget the 20-year period, it'd be looking at somewhere paying around $89 million. Whereas, because I think that's in your far left column there on the annual payment to amortize UAAL.
Correct. That's what you would do now if you didn't do a bond issue.
And so then the option that you presented the other day, playing it out with all assumptions being, you know, static and being met in regards to that, it's about 69.46 million of payments, and then option C 70.37. So there's not a significant in the grand scheme of things, there's not a significant difference on B and C in regards to the final amounts paid. Is that an accurate reading of what you're saying?
Yes.
Okay. And also, again, all things staying the same, doing nothing, if we were to pay it out by the 2040 period, our last payment would be about 5.9 million in regards to that if we were to
That's
put
if,
that out.
that's if we
If we do
don't,
nothing.
if we do
If
nothing.
we do nothing other than what we're doing now, and assuming everything else is static.
Right.
All right. I got a couple questions then for Manager Crow and Director Abukis. One, I mean, I'm comfortable with what the presentation says in regards to the numbers and what the risks are one way or the other, and all the caveats on that. Kind of some of the practical considerations that I'd like to have us look at as we go down the road on here is, okay, here's what we know the number is that we're spending towards pensions today. And looking at, I'm calling option B and C, but the two options, one starting with the $2.9 million of debt service, and the other one starting with the $3.226 million.
Right.
Those two options, what does it look like if we were to do that? And again, making these same assumptions, but from a budget perspective, for us starting now, what does that look like in regards to what are we paying right now? What are we going to pay to have to do debt service plus the normalized costs? And what impact will that have on us on this next budget year for what's the shortfall in either model for that? And then knowing at least in one of them, if we do the one that has the largest potential savings because we're paying more upfront in regards to that, and if we have a budget shortfall on that, what are the potential options that we have, both from a If we were to handle it from an increase in regards to property tax, what would that look like? And I think you have that number maybe already, but let's just talk about this as a whole. What are other options? You know, I mean, obviously, if we were to looking at cuts in regards to that, cuts plus revenue, revenue only, you know, what does that look like, and how do we get there if we do this? And then finally, the other question that I kind of want to explore is, under either option, what other, I mean, this is obviously a significant tool to get us to a point and then give us a chance of maintaining that point up until the point where the debt service is paid off. But over the next 3-4 years, if we have adverse market conditions that create an additional new unfunded liability on it, what other tools do we have? And also, I'd like that discussion in the context of the census results and home rule discussion coming out. Again, I'm comfortable now, and I appreciate the additional figures that you presented. Those are the questions I need to kind of look at next for, I guess, the kind of nuts and bolts. If we pull the trigger here at this time, what are we going to do?
Some of these things we actually have answers to
Okay.
here. So, Randy, you can jump in here. The amount of net total debt service can be covered by our current taxes and personal property replacement tax, and then our regular normal yearly obligation, with the caveat, as we built this in, we built about $100,000 increase per year
Under the newest model.
under the newest model.
Under the newest model, you're saying no changes would have to be made in year one. However, for about 8 years, you're going to have to come up with an additional 100,000 each year until we
Correct.
reach the plateau again.
That's correct.
Okay.
Uh,
Option.
And then our normal payment will be covered based upon what we have for, what we're currently getting for taxes from gas and electric can be covered under would cover our normal yearly, charge. That's what we had run. I'm gonna ask Randy, we had talked about that.
That was correct up to about 10 minutes ago. I talked to Bob, and he gave me some new numbers as far as our normal cost because some changes in assumptions. But so our electric tax that we have that's going to the fire pension fund will be a little short by looks like by about $90,000.
Okay.
So it's going to cover most of it. And on the electric end, we're going to be short by about $70,000. So for the
Gas.
most part, we could, gas. So for the most part, we can make up those shortfalls with the utility tax. There again, we don't even have a full year of electric or gas tax in the book on our books yet. So I'm basing this off of 7 months of collections. And the gas tax right now, we're collecting most of our money, so it should be better. As far as property tax, we're looking at possibly a $67 increase to a house of $100,000 to maintain
Get that.
where we're at.
100,000.
Would that be under the option that puts us at the higher debt service level up front, and then doesn't have as many?
Right, that would be your plan C. But there again, I haven't even talked about the personal property tax, which is another $400,000 that we could put towards it, so that could lower the property tax.
I'd like to operate with the assumption when we're talking about these figures that we're using property tax, using the personal property replacement tax, and using the utility taxes, which is what I believe we're doing right now.
It is.
For
It
this
is.
year.
Yes.
So I'd like to operate under that same assumption when we're talking about adjustments for property tax. That make sense?
Yes.
And then the thing is that these will be, talk about, so when we talk about the census and home rule, loss of home rule, one of the things is these will be general obligation, taxable general obligation bonds. So under the rules is non-home rule communities can still raise taxes if required to meet their general obligation bonds. So that's,
Understood.
so,
If we could And so I understand you to say that, because I know this was kind of the intent when we asked them for that latest option. The intent was just to kind of make it neutral this year, but the understanding is then 8 years down the road, you're gonna have 800,000 more you gotta come up with on an
That's
annual
correct.
basis for debt. Whereas under the other, you had the paying up front, about 400,000-ish, give or take. I mean, we're loose numbers, but about 400,000 paying up front, but then it's pretty stable in regards to it. So that's where I'm going with, you know, okay, if we're needing about 400,000 from where we're at right now, what would that look like
Okay.
on there?
So one of the things I know, you and I had talked individually to the rest of the council. So right now, our EAV is about 213 million. Our EAV prior to the 2008 crash was 248 million. So we've seen a decrease. Now what we have seen is an average EAV of going up about 1.3 million over the last. So we've seen an increase in EAV on an average of between 1.3 and 3. We had about 1.3 million because we had a year that we only had 200,000. One year we had 3.1 million increase. So considering that that will result in about 60, about $60,000 more dollars for us in taxes, but which will require some raise out there. We can average all that out for you.
If you could. Additional questions? Alderman Burberry.
I apologize for being late. On the first page, it mentions estimates the city could borrow at about 3.7%. Was that addressed? And what goes into that, the 3.7%? Because 30-year governments are less than 2% today.
True.
And so I'm just curious what goes into the 3.7%.
And I did mention that is.
You did,
These
okay,
are
sorry.
these are numbers from 2 weeks ago, so you can pretty much say that they're very, very, very conservative. So you are correct. I mean, we're seeing the 10-year treasury, which is the barometer of our market, south of 120. I mean, rates we haven't heard of, but these numbers are, I would say, we wouldn't, usually they're not dated by being a week old, but they're dated.
Thank you.
And the Fed has said that they're gonna drop rates another 0.5%, possibly.
Yeah, and the market, as of today, is pricing in a 90% chance of that drop happening.
Well, obviously, this is a long-term play, you know, and it's good, that's going to exceed, I would assume, any of us, probably, you know, or most of us at this table here in regards to it, but is there any additional information that any alderpersons would like to request as we come to a decision on, you know, no entirely, yes to this option, or yes to this option? Are you at the point where I need some feedback, I guess, from you guys, because being a committee of the whole, are we at the point where we want to see these in, you know, well, I assume it would be in ordinance form?
So what we would actually have to do, we would have to do a notification for a public hearing for the sale of bonds. Kevin, you want to step up and take us through as our advisor here?
Sure. You're right. The first, if you decide to issue bonds, the first step would be to have the hearing. And then you could issue the bonds anytime thereafter with an ordinance. If you need to get a consensus and you feel that that'd be better through some sort of a motion or passing some kind of a consensus ordinance or something, I suppose. But from the bond viewpoint, your home rule, you just need to hold a hearing, and then after 2 weeks' notice, and then you could issue bonds the following meeting or whatever.
And we actually have to publish the 72 hours prior to the council. A little bit different than normal agendas. If the Council of Ordinance, Chapman, who's our attorney, wants that published 72 hours prior that agenda. We've run into that with them before, that they're very hard on that.
Yeah, so there's some timing things, but basically, it's the hearing, which is not a voting hearing or anything, you just want to give people the opportunity to speak, and then the vote for the bond issue itself.
And whichever option we choose in regards to that, as long as the dollar amount that we're doing is the same, you can handle that under one hearing.
Yes,
So,
yeah.
yeah.
And usually the hearing would, on something like this, the hearing might say, a hearing to authorize, to take comments on selling not up to $50 million of pension obligation bonds, which doesn't require you to sell that many.
Sure.
It just authorizes it, and then it permits you to do it over the next 3 years.
That was right, I think I'd seen something recently where bond counsel is of the opinion that those hearings are adequate for up to 3 years.
Yes,
So,
yeah.
okay, all right. Additional comments?
Mr. Chair.
Yes, Alderman West.
Yeah, with that, having to wait for the hearing and whatnot, when would we actually lock in the rates? You know, you're talking about rates being low right now.
Yeah, I mean, well,
If we're looking at 2 weeks or something, for some reason it goes back up, I mean,
Well,
when do we lock those in?
sure. You don't lock them in until you do the bond ordinance. So let's assume that you decide to proceed. You could do the buying a hearing, the Bond Information Notification Act hearing, buying a hearing in about 3 weeks with the notices and the publication and everything. You could, do 3 weeks from now. You could then, we could probably be in the market 2 weeks after that. So, I mean, unfortunately, it's not something you just snap your fingers at, but it is, let's say 4 or 5 weeks, you could lock in those rates. And then those rates are locked. Once you vote on them, the rates are locked. Then you spend 3 or 4 weeks doing the paperwork, getting everything delivered.
Follow.
Go ahead.
So if we were, if we're watching the market or whatever, we could, after we've had the hearing, can we kind of give authorization to you guys, okay, watch it, and as soon as you think the rates are gonna be at the best they're gonna be, then hit the trigger on it, or,
Yeah,
or
well,
how we get the best
yeah,
deal
yeah.
for the city?
Yeah, the difficulty is you always know where things are today and yesterday, but never tomorrow. So you would want, you could certainly say, okay, and first of all, to lock in those rates, your staff would, we don't make the decision, your staff, and then you vote on it, but you would probably indicate a comfort zone. Just as the rates that Stefan's got in here are the 370, which was from 2-3 weeks ago, whatever. Today it's probably at least 0.5% less, but you don't want to keep chasing it down because a week from now it might be 0.25% up. So this gives you a real good flexibility here, a sense of where you could be, and it should be better if it keeps going down. So I would think that if you get we're all ready to pull the trigger and we're someplace around this range, then you do it. But if rates reverse and something weird happens and rates go up a full percent, then you just stop. You've got time. You just stop and you say, okay, let's discuss it. You don't have to, because again, the buying hearing is good for 3 years. You could even, if you wanted to, you could even do a bond ordinance just to authorize a later sale, and then usually be the manager and the mayor make the final decision. But it's hard to watch the market because you never know what tomorrow is going to bring. But so when you get to a comfortable zone, then you just do it.
Chair.
Alderman Ross.
Okay, I see that you have 2 options up there. This may sound like a little far-fetched, but is one a short term and a long term?
No, they're all, each one of those is if you sold the entire bond issue, and they both go to 2040, which is where you're supposed to go right now to fill up your pension obligation. So these are just differences. One, as was pointed out, you have level debt service at $3.3 million for the next 20 years. The other, because it was requested last time we were here, the other starts out lower, so you have some savings. That one up there, you have some savings, so it gives you more flexibility and more comfort as you're doing your budgeting for the next several years. And then you get to a point where you get level debt service. So it's just different options. As was pointed out, the savings is about the same on both, but there's different budgeting constraints. One has you start out $400,000 higher, but never going higher. The other has you start out $300,000 lower, but you do go higher.
Follow up real quick.
Go ahead.
Would there be a, with all due respect, a common sense approach to this as for the options?
Well, I'm not sure what common sense is in this case. It's like the discussion was. It's a budgeting thing. If Randy feels comfortable that he can make these numbers, you might want to do this. That would be, to me, that'd be the common sense thing. If you really felt that you want to push yourself and do the other version where you had level debt service, just 3.3 million forever, or for 20 years, that might be, but that gives you less flexibility. So I'm not sure it's common sense as much as this gives you some greater flexibility in your future budgeting.
Okay, that's
Okay.
common sense
Yeah,
answer.
okay.
Thank you.
Chair.
Alderman Borneman.
Thank you. With regards to the 89 million, what is the certainty of us paying that amount? If we do nothing, this chart says that what we would have paid over 20 years is 89 million.
This is a question more for Lautenbach and Amy.
So the payment towards 89 million is just pretty much amortizing your existing unfunded liability as it is today. And, that would be pretty much, again, using Mr. McClanathan's, all the caveats considered, the expectation going forward every year, those would be what you'd have. That does not take into account any interest rate changes or assumption changes or legislative changes with the consolidation. All those sorts of things are not considered in those numbers right now. So there are some differences, and we even know that the consolidation exists. We would suggest probably rerunning a new set of numbers as of 12/31/19, your new fiscal year end. We're working on those right now with the data and all that to kind of revise what the amount is. So when Kevin said, not to exceed 50 million, that's probably a good number to go towards, because you're probably going to see a slight increase from what you have outstanding today.
And one of the things the council needs, no one's really sure what's going to happen with consolidation, whether it's going to be like we have with IMRF, where they come out and tell us. So each year we get a payment that says, here's what IMRF, here's your payment, here's what you got to pay. Whether they're going to give us a length of time. When I know at one point there were communities that were underwater with IMRF, and they were saying had to pay it back over 10 years. And I was in one of those communities. We had 10 years that we had to pay it back. Or where they're going to say, we're going to set it up, you got to pay $1 million over your amount until you get the 90% liability. Now, the one thing I will tell you that the actuaries, I assume this is the 100% liability versus 90?
I believe so, yes.
Yeah. So the state of Illinois requires 90%. The actuaries and bond rating requires 100% payback without liability.
Well, go ahead.
So that kind of touched on my next point. This $89 million in payments over 20 years would get us to be 100% funded,
In theory, yes.
in theory. And there's a possibility that 2040 date gets pushed back.
There's all sorts of talk of whatever's going to go on with the legislation, with the new consolidation. We don't know if they're going to play around with that funding target. We've heard, prior to the legislation passing, we've heard other bills that were there. They're saying they're going to drop to 90% to 80% by the year 25. There's a lot of different things that were out there prior to what was finally just established. And what was just established with the consolidation bill was primarily for investment purposes, but they didn't touch any of the statutes other than some small tier 2 benefit increases that they included in there. But everything else is still on the same targets it existed today prior to the legislation passing.
Okay.
Go ahead. Thoughts?
Just so just procedurally, we're talking about borrowing or bonding somewhere in the area of $48 million. That's what we're talking about today.
Yes.
And if we did that, that would make us 100% funded in our pensions, public safety pensions.
Correct.
And then going forward, we'd make our regular payments, but we'd also have to pay the debt service to the bond.
Right, you'd be paying your bond payments, and then you'd be paying the normal cost for the accrual benefits that are from all the active police and firefighter that still are in the fund.
Mm-hmm. And that's something that increases every year due to
Typically.
retirement and things of that nature.
Not retirement so much, but just basically pay increases.
Right.
As employees earn more pay, they're going to be earning more benefits, so that would go up. But some of those items are included in the projection and the normal costs already. Other things that would happen is if you don't hit that 6.75% return in a particular year, you would have what we would call an actuarial loss, which may create a new unfunded liability. So it might, let's just say it's only $100,000. We'd amortize that over the remaining period, which wouldn't be a lot up front. But if you had a very bad economic year, say for example a 2016 or 2008, something like that, where you really had a very, very negative returns, you would create a new unfunded liability, and that would now be in addition to this debt service that you're paying off as well. And that is one of the downside things that Stefan addressed.
Right. If we did this bond, we wouldn't be needing to make the 6.75 benchmark anymore. It'd be 3 point something.
You would still need to make that because your existing liability is still accruing at that 6.75. The assets are accruing at 6.75, we're assuming, but your liability is also going to accrue at that 6.75 as well. So that's where we try to set those. So if you're both getting the same amounts, they're growing together, and you'll stay 100% funded. But once the liability, what happens is the liability is locked in to grow at 6.75. That's going to happen. If your assets lag behind that, that's where you get that shortfall, and that's where that unfunded piece comes from.
Okay.
City Manager?
Well, and one of the things, this is conservative because one of the things we looked at was what our average return, and that's one of the advantages now is with the consolidation of more assets to invest, the likelihood you are going to receive that 6.75 on a yearly basis on an average basis, and that's the key. On an average basis over the life of this debt is more likely.
Right, and that was one of the main components of why the legislation passed, was because right now the police and fire pension funds are handcuffed a little bit in how they can invest their money. Going to the consolidation, if they should go to how they invest in IMRF, for example, you can invest in a higher percentage than 65% in equity. You have other alternative investments that may be higher yielding that would give some advantages to the fund, and you actually earn more than that 6.75. In addition, we don't know who the new actuary for the consolidated funds will be when they are picked. They are going to come up with their own set of assumptions, and they may pick a 7% expected rate of return, for example. Right now, IMRF is at 7.25%. So if they set that as your new target, that means your unfunded liability goes down. So you could see just savings on just the interest assumption changing. It's not something to bank on. It's not something to make a decision upon, but it could be almost a safeguard that could happen in case of an adverse economy or environment.
So what's the pleasure of council in regards to, obviously this isn't a final decision, in regards to this action, but I mean, did you want some more additional information from the staff? I mean, obviously we're going to be getting some more additional information from the staff in regards to some of the things we talked about. But are we gonna sit on this further? Are we gonna, move forward? Are we looking to potentially put this on hearing down the road? Where are you guys at in regards to your comfort level?
Chair.
Alderperson Brashaw.
Thank you. I was hoping for some more guidance from either Randy or Lowell. If they could give us their viewpoints on how this would help our budget. I mean, I realize that it would, but I mean, this is a $48 million decision that I'm not prepared to just jump into, and I'd like some of the people that actually do the finances for the city to weigh in on it.
Randy, do you want to start here?
Sure. I kind of look at it this way. We're either going to pay today or we're going to pay tomorrow. If you look at the charts, you'll see that our liability is increasing each year. So we're going to have to do something, whether raise taxes, reduce fees, lay people off, cut whatever we can out of the budget. But we're going to have to do something. And what we're doing now is really is kicking the can down the road, something that the state of Illinois did for many years. With this alternative, we are taking some risks. There are risks out there. There's interest rate risks. There's the economy that could tank at any time. Likewise, it could go up. Our past over the past 10 years, our rate of return has been about 6.1% on the police and fire pension funds. So this past year, or maybe 2 years ago, we were expecting 7% interest rate or 7% return, and we weren't getting it, so we lowered it to 6.75. So that added more liability. So by consolidating our funds with the state, we don't know whether they're going to mandate 100% liability payment. We don't know if they're going to mandate 90%. These are questions that are still out there. I don't think they know yet. They haven't appointed a permanent board yet. So from my perspective, I'm looking at it that this is an alternative, especially this Plan C that we're talking about, is a good alternative that we really should explore and look into. In the short term, we're going to have to raise taxes a little bit, is my prediction. We can take the $400,000 that I didn't mention about the personal property tax, and if we take that and lower it from $2.9 million to $2.5 million, it's basically what we're levying now. We're levying just over $2.4 million in property taxes. So there's going to be a small increase. There's going to be an increase no matter what we do, and I think you really have to consider that.
So when I looked at this, we looked at it very carefully 18 months ago, or I think it was 18 months ago. And what I looked at now with the consideration of consolidation and the advantage that gives, and along with that, with the fact that the market is at historic lows for bonding for municipal, it's kind of, I view it as this is the perfect storm to make this move if we're going to make it. The other thing is, I view this, every move that I've directed the staff to do and to look at is in protection of us of possibly losing home rule. And this is another protection that places us in a position where if we lose home rule, we'll still be able to maintain our ability to cover the pension obligations that we have without, because once we get to home rule, we can increase for our taxation for the bonds, but other than that, we're limited to a 2.5 or whatever PTEL is, which is a factor that is established under COLA of being able to raise taxes, and we're still going to have to offset some type of a loss in revenue from sales tax and some other taxes that we have to do. So this protects and gets our liabilities for our bonds covered. And what really hit home was the last bonding when we went out for our street bond, and we went forward, and our rating agency said, we have everything in place. We've had the first 3 balanced budgets that the city's had in over 10 years. They like what we've done with the management, the fact we're building reserves. You know, we've done that since Randy and I really pushed for that. We continue to put 250,000 in reserves. We have an additional payment. But they say that the liability is the biggest fault we have in trying to increase our bond rating. And we're starting to see the economy. You know, we've issued $26 million in building permits in the last 2 years, and I see everything's pushing the right way, but this is becoming a real drag on the way we're doing business and what we're having to throw, because all of our property tax right now is going into fire and police pensions.
Alderman Borman.
Under an option where we do this obligation bond, do you see a decade down the road, or at some point where all of our property taxes aren't going towards those bonds, or is that always going to be the case?
20 years down the road.
20 years down the road.
Until
Yeah.
And along that point then, if all the assumptions get hit, then 20 years down the road, in a typical year, we're dealing with almost only the normal operating costs, correct?
Correct. So, but what I look at is, if we don't do it, and we look out there, we're gonna have to come up with $5.8 million, and then so where's that money gonna be coming from? It's gonna be coming out of the general fund, which is already being decreased, pressurized because of the loss of home rule.
Go ahead.
With regards to the downstate consolidation of pensions, we don't know how that's going to play out, right?
So they are just now putting the boards and panels together, and they've really left a lot of the power within the board itself and how it's establishing it. It still has to play out. They have we're in the 26th month of 30 months. They gave them 30 months to establish the rules on how we're doing it. And I think we're in the 26th month, or when was it? Is that right?
Yeah, it was effective 1/1/2020. So every fund the 30 months started at 1/1/2020, so July of 2022, every fund must be transferred into at that point in time. And as Mr. Crow said, they put together some temporary boards. So they outlined a structure of this is what they want to do, but there's no skeletal part of it how we're going to do it. So that's the nuts and bolts of everything, is how it's going to work, is how well can these boards get together and piece together the administrative practices and how they're going to actually make all this consolidation happen. Some things we do know is they're going to audit each and every fund. They're going to freeze your assets at that point in time, then they're going to transfer your assets over into what we call one of the 2 mega funds, and then then you'll be considered in the new fund. So they're not going to do every fund at once. They're going to we don't know if we're going to start with big funds, small funds, alphabetically, however they choose to do so. Once they get this in place is how they're going to start transitioning funds over. You will need to keep some assets in a separate account just to make sure you can make your monthly benefit payments and those sorts of things. But yeah, so there's a lot of, they have to come up with a new actuary. They have to hire all the new investment advisors and all those sorts of things. They're going to have an executive director for each of the funds, probably with a staff that they're going to have to hire on and do all these things. So a lot has to take place before they can even start to audit or start to take over the operations of each fund.
And the executive director for both the fire and police fund has just been advertised.
Okay.
Mr. Chair.
Alderman Busker.
Yeah, a couple different questions, probably for Randy or Lowell. With, the consolidation thing, we don't know what our payments would be to there. Here we've got an idea of what our payments are going to be. Do you feel comfortable that making these payments, we'd still be able to offer the same level of services to the constituents that we have now, or are we going to be cutting services? What's it looking like?
With the bonding out, I think we have a better chance of maintaining the services, because we're not going to have to reduce services in order to pay the pension liability. So what we're looking at is if we don't pay that, we don't know what the requirements are, but we know that we have this outstanding bill out there that we are going to have to pay.
And follow up.
Go ahead.
And with, with this, the state can come in and do whatever they want, but, if we do with this bonding thing, are we still gonna be having, later on down the road, is the state gonna still require us to send a payment down to them for, would that be just operating costs, or how's that gonna work?
That would be our normal costs, and as Bob pointed out, we were gonna have to keep some funds back in order to pay our pensioners. So part of the property tax levy that we levy will, or through the, actually will be through the utility taxes that we have and the personal property replacement tax. We'll probably keep that money, most of it, so that we could pay our current liabilities.
Okay. And we have no idea what the state's gonna do with that yet.
Well, no, not really.
I guess one of the ways I see this is, it looks at, all right, if our goal is to get to a healthy situation, and 48% and 65% funded isn't a healthy long-term situation. So if we're ever gonna get ourselves to a healthy long-term situation, yeah, you got an option right now of continuing to do what we do in regards to this, but at some point, I mean, I was looking at the numbers that you had in the consent agenda for the next item. I mean, you had a nice return from the end of April to December, but you go ahead.
Well, you have to remember though too, that's only for an 8-month period.
Exactly.
So we didn't have all our expenses that normally, we had all our property taxes in, but we didn't have all our expenses. So starting January 1st this year, we've got expenses, but we have no income coming in.
And where I was going with that was, even looking under that picture, which was even a rosier than reality picture, I mean, you're dealing with, 15, 16, 17 years of replicating that, which isn't going to happen. I mean, you're not going to have market conditions like that. So bottom line, how do you get to a healthy situation where, if it plays out correctly, 20 years down the road, you've got a community that does actually have a lot of resources to play with that we don't have right now because it's going to pensions. You're going to have your normal operating costs, but good grief, having the normal operating costs even 20 years down the road, let's say it's $2 million a year as opposed to $1 million right now, whatever. When you take off the multi-millions of the debt service on it or the unfunded liability burden that's on it, that gives the community down the road a lot of resources to potentially play with. Now, again, is it going to be perfectly rosy as it is here? Maybe not. Potentially could be better, certainly could be worse, but you've got a fair amount of cushion there in regards to it, where you still come out with some savings for whoever that council and community is 20 years down the road. We're fast approaching the end of our time, but Alderman Burberry?
Just an observation, when I was introduced to this concept about 18 months ago when I joined the council, it seemed extremely risky. On the other hand, talking to some folks in the community, some people in finance and investments, it seems that a bonding way is a good way to go. As Peter just said, you're not going to eliminate all the risks. There's no absolute guarantee, but I think part of our responsibility is to be the steward of the resources we have and to make those work as best we can. And one of my concerns previously was committing this council, if we all voted in favor of doing this, committing this council for 20 years down the road, not knowing what the future would be. But I think that's what people in leadership position are supposed to do, is make that kind of decision. So I would believe we should move forward on this. There might be more questions, more details, but we should get the ball rolling.
And I just have another.
Go ahead, Alderman Ward.
I'm trying to make this as clear as possible for everyone at home and for myself. We're talking about column 3 here would be, if we did nothing, those would be the payments that we would have to, the money we would have to come up with to get fully funded by year 2040. And we don't have a choice. The statute is requiring us to get at least 90% funded by 2040, right? So this isn't something we can just say we're not going to increase payments every year. We have to do that. It's fair to say.
I would say so, especially if the state's now controlling our pensions for us. That as council, you can't say, well, this year we're going to only fund 80% or 70%, next year we'll fund 95%. I don't think we'll have that option. They're going to tell us basically. My opinion is they're going to tell us how much we're going to have to pay in.
And so then you look at column 6, it's, that's, we're seeing less money we have to come up with, which means less things we have to cut or less taxes we have to raise. That's as basic as that. The one left to the left of the gray column.
$70 million column.
Yeah. And if we did nothing, there's still a chance that this 89 million, we pay much more than that. The market could always change and affect us negatively, even if we did nothing. That's true, right?
I'm sorry, I was playing with my pen. I didn't hear the beginning of your question. I was trying to get my pointer working. It's an old one. So I apologize.
I guess just, and it's kind of a rhetorical question, but if we did nothing, there's still a chance that the markets could tank and it would still affect us negatively, right?
That's correct, yes.
Well, I agree with Mr. Berberet that this isn't an easy decision, and as Ms. Bradshaw put, this is a $48 million decision, but it is, part of our obligation as council people to make tough decisions. So we would need to see this moving forward in ordinance form or drafts, obviously, and I still would like to have a longer discussion on this, but that's all I have to say.
So I take that as to, because obviously we can't take final action in the committee of the whole, but looking to directing staff to bring us the next steps, obviously from a legal standpoint and from the hearing standpoint. Is that what I was hearing from you, Alderman Borneman?
To another committee of the whole, finance committee of the whole.
Or you could, go ahead, City Manager.
I was gonna recommend, we have another committee of the whole next Monday.
Oh, yeah,
And we can start planning on getting some numbers. I've talked with Randy, because I know he does have a couple days vacation laid out there, so.
Will you be able to handle next Monday?
I promised my daughter I'd go visit her for Christmas, and that's this coming week.
So, but we can,
You'll be able to bring us further information next week. I mean,
Yeah.
obviously.
a
yeah.
timeline, and I can get some stuff.
So there's a motion to bring back further recommendations and plan of action at the next committee of the whole meeting next week. Is there a second?
Second.
All right, second by Alderman Busker. So that motion was by Borneman. Did I consolidate your motion accurately?
Yes.
Okay. There's a motion to second. Any further discussion? All in favor of that motion, say aye.
Aye.
Opposed? All right, the motion carries. Is there, that is the last item for the presentation. Is there any public comments on the Finance Committee of the whole? Seeing none, is there a motion to adjourn?
So moved.
Second.
A motion by Alderman Busker, seconded by Alderman Ross to adjourn the Finance Committee of the whole. And for those, if the TV's on right now in regards to that, we'll have our regularly scheduled council meeting in a moment. All in favor of the motion to adjourn, say aye.
Aye.
Opposed? All right, this Finance Committee of the whole meeting is adjourned. I recommend that we take maybe a 3-minute break and then start our regular other scheduled council meeting. All right.